All right, welcome to SilverOak's quarterly webinar. As usual, I'm Shannon King, President, Partner, and Chief Compliance Officer for SilverOak, and with me today is Jonathan Charlo, a partner as well. In addition, you, Jonathan, are our lead analyst. For today, we're going to go through the economy and SilverOak's dashboard. We'll talk about the market performance for the quarter. We'll then shift to our outlook for the next couple of quarters, looking out into the following year. Our special topic today is going to be a comparison of savings vehicles for children, because Jonathan, I know you've been getting a lot of questions about the new Trump accounts. I have as well, and I know our other advisors have. So we're going to talk a little bit about the Trump accounts in comparison to other vehicles that are available. And then we'll go through our SilverOak updates. But before we get started, I just wanted to mention our webinar is scheduled for 45 to 60 minutes. It will be posted within the next couple of days after the webinar is completed. If you have any questions throughout the webinar, please feel free to contact your SilverOak advisor after the session ends. If you're not working with SilverOak or one of our advisors, feel free to contact me directly at 952-896-5701. And of course, I want to thank Jonathan and the rest of the team for making today's webinar possible. It really does take a whole village to get this information compiled, and even just to coordinate the technology. So thank you for everybody involved. Since I am the compliance officer for compliance purposes, I must note that we will be discussing the overall markets and economy during this webinar. In doing so, we'll be providing our interpretations and perspectives. You should not rely upon this information as fact when making any investment decisions. Also, we will not be discussing specific SilverOak portfolio performance, as each of our clients' portfolios are customized. Nonetheless, all of our clients should have received their customized performance reports here within the last week or two. If you have any questions, please reach out to your SilverOak advisor if they've not already reached out to you. And lastly, past performance is no guarantee of future success. So with that, and having looked at the agenda, let's jump into the economy. And we'll start with the dashboard as we typically do. If you're new to the webinar, the dashboard is broken out into four major components. And then those components are brought together into a composite. So Jonathan, where do we stand on the first component of the dashboard, the economy?
Economic numbers have actually been very strong, and you'll see that as we go through the webinar today, and we'll highlight different areas.
Perfect. How about the second component of the dashboard, credit markets?
Credit markets are still green. Now, we're going to show you a little bit, but we did see interest rates increase a little bit, so the green shade is a little less than last quarter, but that could be a more temporary situation.
Sure. And I guess I probably should explain for those that are new to the webinar, if the box representing that particular item for that particular quarter is a dark green, that's very positive. If it's a light green, it's positive, but maybe a little bit less so. If it's gray, it's neutral, and varying shades of red are more negative. So the third component of the dashboard, the third of the four, is valuations.
And valuations have remained red for a long time. Yes. And we've talked about that perhaps that has to do with the composition of the type of companies today relative to the past. We're actually going to show a slide that the valuation has actually gotten a little bit better. But in terms of the purposes of the dashboard, it's still red.
Got it. And then the last of the four components being market sentiment.
And market sentiment is, still very positive. Now, it is a little lighter than last quarter. And what I would say there is that market sentiment also does include other types of sentiment. And so we don't show a slide, but consumer sentiment is very negative. And that's something that we've actually seen for the last few quarters.
Although we have shown slides in the past that consumer sentiment is almost negatively correlated with future performance.
Correct. Correct.
Okay.
So,
Well, if we bring these four major components together, we have our dashboard composite. And what are we seeing here?
it turned green, and we kind of projected that based on the trends from last quarter that would happen this quarter, and that occurred on schedule.
Perfect. If we look at the dashboard in a slightly different fashion, this is showing the 6-month average dashboard in yellow, and then the dashboard composite in black. And I think basically what we can walk away from this slide is that both the 6-month average and the dashboard composite itself are kind of in that more positive range.
Not solid green yet, but in that kind of light green.
I like your optimism.
So,
yet.
That's
like
true.
that.
That's true. It's hard to know, but when we look at the economy and some other things,
Yes.
Things are very positive.
Agreed. Yeah.
So,
All right. So let's take a look at various components of the dashboard. And here we're going to look at one of the subsectors of the economic section, and that is the ISM index.
yeah, and here we look at manufacturing and non-manufacturing, and the manufacturing is the green color, non-manufacturing is the blue color. So what we're actually seeing, actually it's black, I'm sorry.
Yes.
Sorry about that. You can see in the circle at the very end that the manufacturing had been weak for a number of years, but has been surging. And one of the things that has really occurred in the last quarter or two is the pickup in demand for semiconductor chips, not just the graphic chips that NVIDIA produces for the data centers, but now that more people are using AI and AI agents, we're actually seeing a huge demand in regular CPU chips, and we're seeing a demand in memory chips. And so that's actually what we're seeing in that manufacturing. We've actually seen the non-manufacturing coming down just a little bit in the last month or two, but still very positive.
And the unemployment rate?
The unemployment rate, if we look on the bottom of the screen, has actually come down a little bit. And so what we've seen is a stabilization in the labor markets. Now, in terms of new jobs, we're down significantly from where we were a couple of years ago, but we seem to have found a decent level. And from that perspective, the labor markets have more or less normalized.
Got it. We are hearing a lot about housing, and so this is showing housing starts.
Yeah, housing starts have been really pretty flattish for the last couple of quarters, and I think a lot of that still comes down to interest rates.
Yeah.
Compared to some periods where mortgage rates were much higher, they are up from where we were early in the pandemic, but we're starting to hear more of a normalization. But in terms of starts, there's really no movement.
Okay. So let's transition over into the credit markets. So this is the second component of the dashboard. And one of the subsectors of the credit markets that we monitor and measure is the yield curve.
Yeah, and just as a reminder, when the yield curve is negative, in the past, that tended to be a good predictor of recessions. Now, this last time around, it did not. But one of the things you'll see is that if you look carefully, the green line actually came down a little bit. And that is reflected because we're really measuring the 10-year Treasury versus the Fed funds rate. And what we actually saw is the 10-year Treasury yield actually ticked up in the quarter around fears about inflation caused by Iran and higher oil prices, which then the market for a time was pricing in the potential for a Fed hike.
Right.
Now, with some other economic data that's come out, including CPI a week or so ago, that viewpoint has maybe dissipated a little bit, but that's what we're seeing in this number.
Got it. And that 10 and 20-year Treasury, I mean, that's what's been kind of driving mortgage rates up a little in the range. I mean, I think
Correct.
they had been about 6%. Now they're maybe in the 6.5% range.
Yep. Now here we're also looking at the high yield spreads, and so the reason economists and market strategists will look at that is if those spreads widen, so higher yielding bonds relative to treasuries, if that spread widens, that is potentially signaling a bit more distress in corporate credit markets. We're not seeing that. And so on the bottom part, you're going to see that really we've been on the bottom end of that range now for a few years.
Got it. So here we're transitioning from the credit markets over to valuations, that third component of the overall dashboard. And this particular slide is showing the subsector valuations, which includes corporate earnings.
Yeah, so remember, valuations were solidly red and remain so. But one of the things we're seeing is just really strong earnings. We'll show this in a few slides later. But on a year-to-date basis, if anything, we've seen earnings estimates increasing through the year, which is very unusually. Usually you start at high levels and they come down a little bit. And some of that I do think is a bit AI spending related.
The contrarian in me always, when I saw that, we talked a little bit about it last quarter. It's got my hairs on my back a little bit on edge that everybody seems to be super positive on earnings.
True, because I mean you can't sustain 20% plus earnings growth forever.
Exactly.
Which means they will have to come down.
Yeah, eventually.
That growth rate.
All right, and then let's look just briefly here at sentiment, that kind of fourth component of the composite, and this is market trends.
Yeah, and so from that standpoint, this part is strong. We have seen a very, very strong rebound in the markets. You'll see that in Q2 returns. If anything, when we look at general volatility from a market perspective, we're kind of average. But one of the things we're starting to see is some volatility in individual companies. That seems to be increasing. So something to watch. I think also, the green line is the 50-day moving average. That's up quite a bit. And so, that would give people pause a little bit too. And we don't go through it in great detail, but certainly this is a midterm election year. Many tech stocks have gone up a lot. And so, we could see a modest pullback in the markets.
Got it. Well, let's talk about market performance. And you've kind of alluded to it, but obviously Q2 was a very strong period for the markets. As we look here through the equity sectors, essentially everything is double digit for the quarter. And even if we look year to date, I mean, these numbers continue to come in just super strong. Now, I recognize the last couple of days have been a little choppy in the markets, but nothing even close to erasing these year-to-date positive numbers that we're seeing, at least thus far. If we look over into bonds, they're a little bit more muted. We'll talk in a few minutes about bonds. Bonds are providing really attractive yields, which helps kind of give us a little bit of confidence about future performance. But in terms of total return that we're showing here, performance is certainly muted relative to equities. Really, the only sector that we're showing on a quarterly basis anyway being negative are commodities, and they're down. And I think that's reflective of, well, a number of things, but kind of some of the more high volatile assets have just frankly been down for the quarter. I think gold is off its all-time high by like 25%. One that we always like to kind of kid around about, Bitcoin, it's off 50% from its all-time high. Now, granted, both of these assets have done well over the last 5 years, but they're extremely, exceptionally volatile. And I can hardly go without commenting on the SpaceX, because it's down 50% from its high. Now, it just went IPO recently, so we don't have a lot of time here, but it's even below its IPO price. I think what got priced out at 135.
Mm-hmm.
So I think it's trading around 113 today, but very short period of performance. So who knows long term. If we look year to date at these asset classes, performance isn't really all that different from the quarter, other than, as you can see, and I just alluded to, commodities over the longer period have done a little bit better. Let's drill down into the style, Jonathan. And what I mean by style is if we look at U.S. large cap, mid cap, small cap, so these are big companies, mid-sized companies, smaller companies, we can kind of categorize those into growth. Think of more technology oriented versus value. Think of kind of the old economy, maybe financials, insurance companies, things of that nature. So where did things end in the quarter for style?
Yeah, when we look at that, large cap growth had a very, very big second quarter from a return standpoint. And again, that was the rebound that really occurred within the technology sector in the second quarter. But perhaps, the other thing to focus on is really how strong the small cap returns have been this year. And so, there in the quarter, we certainly saw growth do better than value. But when we look at it on a year-to-date basis, they're more or less almost the same.
Yeah, they've been great.
And so really, I think both have done very well on the small cap side. And so then in mid caps, interestingly, in the quarter, returns were not that dissimilar. Both up double digit, but then when we look on a year-to-date basis, actually value is doing a little bit better than growth.
So let's talk a little bit about sectors and what really drove the performance, especially here we're looking at U.S. large cap, the S&P 500.
Yeah, and so if we look on the growth side, I think one of the things that will just stand out is how strong technology was within the quarter, up 32%. And then on the other side, when we look on the value, it was energy was down. And so in the second quarter, we did see energy stocks pull back, and that was largely due to the memorandum of understanding, or the hostilities in Iran coming down, and we saw oil prices come from their recent highs back down. Now, again, July is a different story.
Right.
Oil has come back up.
Right.
But that's really what kind of hit value in the quarter. But again, when we look at on a year-to-date basis, obviously tech is a big driver on the growth side, but we're seeing different industries within value actually having a pretty good year. And some of that is really the AI story with manufacturing and kind of other industries. But we're also seeing earnings growth in general increasing in other sectors.
So let's transition away from the U.S. markets and talk a little bit about the international markets, both for the quarter and the year.
Yeah, so here, I think really what's going to stick out is emerging markets led the way. And then when we look at EM Asia, that led the way. You're going to see China was down, Latin America was down, the big areas were down. And a lot of that comes down to technology again.
Mm-hmm.
So a very common theme. The issue when we look at emerging markets, and especially EM Asia, is if they include Korea and Taiwan in their composition. Korea was up almost 90% in the quarter, and as of the end of the quarter was up almost 120% for the year.
Wow.
And that is memory.
Yeah.
Because the biggest memory companies, Samsung and SK Hynix, are obviously Korean companies. And then we look at Taiwan, also up quite a bit in the second quarter and year to date. So that's really what drove those returns. But then if you look at more developed markets, Europe and Japan also had very good quarters. But again, when you look at it on a year-to-date basis, so much of the second quarter did drive the year-to-date returns.
Sure.
So interestingly, China really has not had a good year, as well as the big countries. And so India, as an example, is actually down on a year-to-date basis.
All right, so let's now transition completely away from equities, whether they're U.S. or international, and let's start a discussion around bonds and bond returns.
Yeah, so if we look on the left side, emerging market and high yield, or more credit-oriented markets, those kind of led the way. But interestingly, municipal bonds did have a very good quarter, and I'd kind of highlight that. Whereas if we look on the far right with the treasury bonds, looking at all the different maturities, that's more modest. And then when we look at it on a year-to-date basis, modest returns, municipals are actually doing well when you think about the taxable equivalent yield with that. And then treasuries actually down just a little bit.
And municipals, I mean, I think this performance is maybe a little bit of a surprise, but probably not a surprise that they're bouncing back. First quarters tends to historically be a bad quarter for municipals because of supply and demand balance, and then they kind of make it up thereafter. So
yeah, definitely.
So let's talk about SilverOak's outlook, and we're going to start with the overall economy. And the U.S. economy, really, a lot of the economies, but particularly the U.S. economy, is just so darn resilient.
Mm-hmm.
I mean, it just doesn't seem to matter what gets thrown at it.
I mean, we threw tariffs at it last year,
and again today or yesterday.
Yeah. And then the whole Iran situation, we had Venezuela earlier in the year.
So. Yeah, it's just really, really amazing. And I think a lot of it's driven off of, the one or two things that we have that nobody else in the world has, and most other countries and governments envy. And the number one would be the U.S. consumer.
Mm-hmm.
The U.S. consumer just loves to spend. And I know we've talked about the K-shaped economy before, with basically that representing the lower income households maybe feeling a little bit more stressed, while the upper income households basically have been oblivious to any of the economic stresses. But generally overall, things are still really hitting on all cylinders there. Now, the durability of this wealth effect, who knows? I think the next couple of quarters will be important as we monitor. But there doesn't seem to be anything, Jonathan, that's really going to derail this at this point.
Right. Nothing on the horizon that we can see as negative. That doesn't mean something won't come up. But at this point,
and certainly something will eventually. But
Right.
It's just hard to imagine. Now, you know, the near-term effects of this war and what, you know, it's going to have on oil prices, inflation, that could be a problem. Although, as you pointed out here, the U.S. economy, it's a lot less vulnerable to these oil shocks as maybe you know, it had been in the past. Fed, we actually think they're going to stay on hold. I've personally believed that for the most part from the beginning of the year. I know it depends on the week as to whether the prediction markets are forecasting a hike or a cut. But I just don't see them really moving one direction or the other. Do you?
I don't at this point, because again, when we look at the K-shaped economy, there are a lot of consumers that are under duress right now. And so to raise interest rates in the face of that, I think the Fed would think long and hard before doing that.
Yeah, and in the face of what's happening in the real estate market, because that undoubtedly would push up the mortgage rates.
Correct.
And that's just not going to help probably the one part of the economy that really hasn't come out of, you know, of its struggles. Internationally, again, I would say overall, we remain relatively positive, but there's definitely going to be some unevenness through the international economies. Europe and Asia, I think they remain a lot more exposed to shocks in energy prices and you know, impacts of that. Although, you know, at least Europe, there's a lot of fiscal spending that's going to probably spur growth. China, they've got their own challenges for sure.
Definitely.
So let's talk about the U.S. GDP growth composition.
Yeah, you alluded to it before, but consumer spending historically has been a huge driver of economic growth, meaning almost, you know, 70% of the economy. Now let's look in the first quarter, and again, it is one quarter, but it is instructive of what is driving growth. And so while consumption, you know, is good, the real driver is the second item, business fixed investment. And so what is going on? Well, we've talked about this data center growth and the boom in AI spending. That's actually what we're seeing. And so for now, that in the last few quarters has been the single biggest factor on top of consumption, which then gets us back to this idea that we just don't see anything on the horizon to hurt economic growth with a strong consumption trend in place and with this fixed investment. And I didn't circle it, but even, you know, government spending was relatively strong. So a lot of drivers at this point.
Let's talk about inflation because I think if you just looked at the headlines, that probably isn't going to be a driver of growth.
No, certainly not in the short run. And so if we look kind of at the right side of the slide, you're going to see the pickup over the last few months. And of course, that is oil driven, which has translated into higher natural gas prices, gasoline prices, diesel. And so we've seen CPI increase. Now, we did allude to when we talked about the Fed that maybe they were on hold. The most recent CPI did come down a little more than people expected. But again, now that's changed even in the last week with Iran. So it's something to watch. But the sticky components that we were looking at over the last few years, those are coming down. Shelter costs are coming down. You can't see it, but right on the last bar, there's a little bit of a negative. That's actually auto insurance. And so I think once we get beyond Iran and see where oil settles, we'll probably again see CPI come down again.
Now, I made reference just a few minutes ago to this K-shaped economy. What do you want to
Yeah, well,
point
let's
out
let's
here?
look at the top. If you look at the top 20%, 51% of pre-tax income representing 38% of spending. So a big driver. But more importantly, if we look on the bottom part, we've talked about the wealth effect. So that same top 20% has seen an increase in their balance sheet of $48 trillion since right before the pandemic. And the other 80% have seen an increase, but again, it's just been so overwhelming towards the top 20%. And if we look on the left side, I think it's instructive. This is really looking at corporate profits versus labor compensation going back to the 70s. And so one of the things you're going to see is labor compensation has come down meaningfully during this period. And at the same time, we have seen corporate profit margins come up. The reason that's important is the top 20% with the wealth effect, they're getting the benefit of higher profits and margins in public companies, which has driven the stock market.
Mm-hmm.
If you're labor oriented and you don't have investments, your compensation has actually been stagnant during this period, and that is what's kind of driving this K-shaped economy.
So let's now talk about our outlook for the markets, because we always have to remind ourselves the markets are not the economy, and the economy is not the markets. And although they may have some general correlation, they're definitely not perfectly aligned. But as we look at the equity markets, you've alluded to it, you've actually mentioned it directly, the AI infrastructure spending. I mean, that really does continue to drive returns. And I would suspect at some point that is no longer going to be the case. It's just not likely to end now,
Right.
or anytime really soon. And corporate earnings, they continue to support the markets. And although valuations, they seem high, I mean, they're kind of reasonable when you start comparing them to the earnings. So, we obviously have to keep an eye on that. But like we've mentioned, it just doesn't seem like there's a thunderstorm up on at least the horizon that we can see. Now, we do expect volatility.
Mm-hmm.
You put it here, second half volatility might actually pick up. It's midterm election year. It's pretty typical as we go into the November timeframe that we have some volatility, and we mean volatility on the downside.
Mm-hmm.
But we wouldn't expect it to be prolonged, deep type of volatility that maybe tends to be more associated with recessions.
Right. And if it happens, from a historical standpoint, the next 12 months, there tends to be a strong snapback.
Got it.
So
now, we already mentioned this, but here, as it relates to our outlook on equities, having that diversification that we really came into the year with, we think will continue to benefit. And that's diversification to small cap and into international, which we talked about how strong those markets have been. So let's talk about the old economy stocks, and what are we trying to convey here?
Well, so much of what people hear is that it's driven the technology stocks, but when you build a data center, there is actually electric equipment that goes in, there's motors, there's a lot of components, and then we have the HVAC and cooling systems that go in place. And so there are actually a lot of manufacturing companies that are starting to see more of a benefit. And I think that's where we're seeing other industries. We're starting to see earnings pick up. That growth has picked up. And we're starting to see a bit of broadening within other industry groups
Mm-hmm.
in terms of their stock price performance.
And as far as AI earnings go?
Yeah, it's still quite a story. So first, I thought we would just kind of quickly talk about the composition of the S&P. So when we put together kind of all of the components on the technology side, it now is a little bit under 52%. But the other thing though to kind of dwell on is that even among technology, there's been some difference in performance. And so on the far left, we look at the hyperscalers. Now, those are the big tech companies like Amazon and Google.
Mm-hmm.
Okay. So interestingly, those stocks are actually down. And then we look to the far right and we see the software companies are also down. So really what's been dominating performance this year has been the hardware side, so semiconductors and things like that. But we're still seeing very good earnings growth. And if you look on the right, even the software companies, their earnings are up 19%. And then you look at the hyperscalers, their earnings growth is up 28%. So
Well, even though performance is down,
correct,
their earnings have actually done well.
And you alluded to this, in terms of the market being not cheap but fair in terms of its valuation. If we look at kind of industry next 12-month PEs, you're going to see that nothing is really cheap, but nothing sticks out. Nothing is 35, 40 times earnings, which I think would be much more concerning.
And we touched on this a couple of times, these strong corporate earnings trends.
Yeah. So if we look at where we started the year, we thought the S&P earnings would be about 12% this year in terms of growth. And right now they're running at 22%. But if you look at where we're seeing those big increases in earnings, it's in artificial intelligence stocks, in this case, 51 identified companies, as well as energy. So that's been a huge driver. Now, if we look at the performance also, you'll see in this case through the end of May, the S&P was up about 11%. Energy and artificial intelligence, because of that strong earnings growth, correspondingly had very strong stock price performance. And so, during this time period, everything else was up, but
not nearly as much.
Not nearly as much. And we talked about this earlier in the dashboard. Solidly red from a valuation standpoint, but technically, if we look here, the valuation of the market has actually come down a little bit this year because of the strong
just not enough
growth.
for our dashboard to
Correct.
shift from red.
Yeah.
Okay. And you had made reference to this, particularly if their market were to have a pullback, but even really strong quarters tend to be followed by strong quarters.
Yeah, and I'll highlight this. Through June 30th, we had 24 all-time highs in the S&P. And the reality is when the market's doing really good, your natural inclination is to say, let's take the money and run, so to speak. But that is really not, from a market timing standpoint, the thing you want to do. And that's what makes market timing so tough.
Yeah. And we don't show it here, but there's two other slides that really speak to that. I think we may have shown it last quarter. I know we have it in some other presentations, but we have a slide that shows over the last 50 years when we are in periods that are within, I think, 5% of market highs. And if you look at the chart, the almost entire chart is shaded gray because we spend the majority of our time in periods where we're close to all-time highs or making all-time highs. I mean, that's pretty pretty normal to see.
Yeah, absolutely.
Yeah, and then the other thing that I always like to think about with these periods of all-time high is it is very typical to see when we have really strong up days that shortly there within we'll have a really, really strong down day. That volatility both on the upside and the downside, they're like magnets. They happen in very close proximity to each other. And typically what happens is you got really good, strong uptrend, then you get a big downtrend that's real short, but people get scared and they get out only to have the market snap back to what you were talking about.
Yep.
Volatility is just like a magnet. All right. So to go on with this, this is basically showing that the 1-year average return following a up quarter, really strong quarter, is 16%.
Almost 16%.
It's not bad.
Yeah. Yeah.
Let's hope that happens. Obviously can't guarantee it. Nobody knows, but let's hope. As far as SilverOak's outlook as it relates to the bond or fixed income markets, I had made reference to this earlier. Yields are attractive, even though total returns are somewhat muted. Yields are attractive, and that is a good indicator of future overall returns. Is that fair?
Yeah, absolutely. That is one of the best indicators of what future returns will be, is the current income level.
Yeah, and you already made reference, municipal bonds seem to be particularly attractive right now. Bonds themselves should continue to provide some stability, albeit I know, even if you're getting a yield of 5 or 6%, that might look not as attractive relative to 15% equity returns. But I always remind folks, that's like comparing a Ferrari race car to a Ford utility truck. I mean, they are there for different purposes, and you wouldn't expect the utility truck to perform like the race car.
Right. Absolutely.
We also mentioned the Fed's likely to remain on hold. I just don't see a lot of movement there until there's some catalyst. Let's touch on the yields.
We've shown this slide before. Really, what you want to focus on is the blue diamonds on the left are significantly higher than the horizontal purple. And that's just showing you the purple is the average returns over the past 15 years, and the blue diamonds is the current yield. So very, very attractive in the core areas. On the right are kind of the high yield EM, things like that. So they actually show higher absolute yields, but those are much closer to their 15-year returns. And so we showed you how that credit spread is so tight.
Yes.
The risk in owning that side would be, if conditions do weaken, then we could actually see those credit spreads widen again, which would then give you negative returns in those sectors.
Yeah, the riskier bond sectors, which we typically don't do a lot in anyway. We stay in the higher quality.
And here we just wanted to show you that bonds do provide typically that downside protection, especially in 20% drawdowns or a bear market. If you own just stocks, typically it takes almost, roughly 2 years to get back to even. But if you have a 40% allocation in bonds, that recovery period is more than cut in half.
All right. Well, thank you for that information, Jonathan. Let's now transition over into our discussion around savings vehicles for children. There's various vehicles. We're going to go through some of the more popular ones. They obviously differ in terms of their purpose, contribution limits, income requirements, tax treatment. the control of the assets and how the asset actually impacts that child's FAFSA or the financial aid processes they're applying for, maybe benefits to help with college. The choices that we're going to talk about are the more common ones: the UTMA, Trump accounts, which are the new ones, custodial IRAs, so traditional and Roth IRAs, and then maybe the one that probably everybody's heard about, 529 plans. And I will be honest, I didn't put these in any particular order other than the UTMA and UGMA, in my opinion, is probably the least likely to be used, just because of some of the downsides, which we're going to touch on. So let's start with UTMA and UGMA accounts. These are Uniform Transfer to Minors Act accounts, or uniform, I forget the G, Uniform Transfer to Minors, or Guardian, Uniform Guardian, yep, minor accounts. So these are custodial investment accounts, meaning that there is a custodian named to oversee them, typically the parent. The parent would typically be the custodian for the child who's a minor. They're not intended solely for retirement, which is kind of one of the benefits here. They're intended for broader purposes. They can be used really for any benefit associated to help the minor. The one downside is once the minor's age of majority, the asset is theirs without restriction. So everybody thinks their kids are going to grow up and things are going to be just fine and hunky-dory and all good. But the fact is that sometimes kids will get off track. And I've had occasions working with clients where there's a lot of money in one of these accounts, and unfortunately the client or the child's got some substance abuse issues, or it's going through some issues with maybe a girlfriend or a boyfriend, and them getting a hold of $100,000 or $200,000 might not be the best thing. But here you don't have a lot of control over that. You also have to remember the earnings here are fully taxable annually. Like, there is no real tax benefit. As a matter of fact, these could be considered falling within the kiddie tax rules, meaning the income, the dividends, the interest, all that, potentially taxed at the parent's rate, not the child's rate. So I'm not a huge fan of these in most cases. The other thing is they're not that favorably treated for FAFSA, for that process of applying for financial aid when the child's going into college. There are occasions where they make sense, but I just don't think there's many occasions. Now the Trump accounts, these are more retirement focused. The account themselves are created through the U.S. Treasury, either using the IRS form shown here or going to trumpaccounts.gov. There's no income requirements. Pretty much any child that qualifies can have an account. They are relatively limited in how much you can put in, $5,000 a year. So you can't get a ton of money in there, but nonetheless, $5,000 over 10, 15, 18 years can accumulate. Essentially no distributions, with very few exceptions, until a child reaches 18. And then think of it as an IRA. Once they're 18, kind of transitions from a Trump account to almost falling within the traditional IRA rules. The government did design these so that they have to be invested in low-cost U.S. equity index funds. And then here's the kicker. If the child qualifies, the government will actually give the child through this account $1,000. So, I know they got some negative connotation for some folks, given the politics of today and the name of the accounts. But passing up $1,000 free money, for the benefit of your child, I think most people would would act on that. And then there's also a good benefit here. We make reference to it. When the child turns 18, and Jonathan, these accounts transition from Trump accounts to more like traditional IRAs, what can happen?
You can start thinking about doing some Roth conversions
Yeah.
while the child is still at a low tax
Exactly.
level.
And what's that benefit? Now these dollars, if they're converted to Roth, grow tax free.
Mm-hmm.
I mean, that is pretty powerful. And there's only a certain amount of money we can get into Roth type vehicles. This just opens up the door to one more vehicle. Not a lot of money potentially, but start adding these together, and tax-free growth is pretty powerful. The contributions here are considered gifts, so we have to take that into account with the annual gift exclusion. And right now, we don't believe these assets are going to be treated negatively for FAFSA. We think they're going to be treated like IRAs, which is quite favorable. But that's not yet confirmed by the Department of Education. So there are a few things about these accounts that just haven't yet been fully vetted. And that's one of them. And the other one is where you can open an account. It's relatively limited right now, but give it time. And I think by the end of the year, these accounts are going to be more widely available through kind of your local brokerage firm, whether it's Fidelity or Schwab or Vanguard or some others.
And then on top of that, eventually one can roll
Yes.
the Trump account. So if you're not satisfied with Robinhood, you can eventually, move it to Schwab Fidelity.
That's a good point as well.
So, yeah.
And of course, we've talked about starting early. These Trump accounts are designed to start saving for children early. And you can see here just the magnitude of growth that occurs over time when you start early. So for those in our audience today who are in their 40s or 50s or 60s, and you're like, I didn't start early. It's okay. Like any savings and any time to start's a good time to start, but certainly starting when you're young is the best. Let's talk a little bit about custodial IRAs. So these are IRAs designed for minors. You can have either a traditional IRA or a Roth IRA. In either case, there has to be some earned income. In either case, the amount's limited. Right now, it's the lesser of $7,500 or earned income. So if your earned income's $4,000, that's the limit that can be put in. If I had the preference here, I obviously would be choosing the Roth IRA, even though they're after-tax contributions, they grow tax-free, and that is just so much more powerful than getting the tax deduction today. So I would highly skew toward using the Roth IRAs for any kids who have earned income. All right, so planning considerations here. We talked about the tax-free growth if you use the Roth. There are earned income requirements, obviously, we discussed that. Assets, they will basically be owned by the child, and the child control them once they're age of majority, just like those UTMAs. But these are IRAs, so there are a little bit more, strings attached to them. And some tax consequences if you take the money out a little too soon. And the other thing with these is they are not negatively impacting FAFSA because they're IRAs. So regular UTMAs do negatively impact FAFSA, but IRA custodial accounts don't. And then here's the last vehicle, 529s. Everybody's probably heard of 529s. They are definitely the leading solution for education savings. Yes, contributions are after tax, so you don't get that upfront tax benefit, but you get not only tax-deferred growth, but tax-free growth if used for qualified education expenses. You might even get a state tax deduction or a state tax credit for contributions. So these are just, they the most superior savings vehicles, particularly for education. There's just lots and lots of benefits, including, if one of the kids doesn't use all the money here, you can transfer it to other kids. You can transfer it to, I think, all the way to what, like second cousins, I think. So they're pretty flexible. The contribution limits are really high. I mean, basically, it's the $19,000 annual exclusion per person. So between a mother and father, that's $38,000 a year. There are limits. Every state limits how much can be in the account. I think it's like 260,000 for most states. And it can grow beyond that. You just can't put more contributions if it hits those upper limits. These are pretty favorably treated for FAFSA. For parent-owned 529s, the assessment rate's only 5.6%, very, very low. If it's a grandparent-owned account, it's zero, like even better. That's assuming that the child's going to be applying for FAFSA. Not all people do. And then you have the ability to convert to a Roth. And there's stipulations on how much and when, but just one more possible vehicle to get a little bit more money in Roth type of accounts, which if you hear about Roth, just know Roth is superior to just about everything. So Jonathan, in conclusion, we say here, obviously align the savings vehicle with your goals, with your intended use. Think about current circumstances, but also long-term planning implications, and probably combine, right? Use a little bit of all of these in some aspect. All right, so let's touch on our SilverOak update just real briefly here, Jonathan. Go through a couple of these.
So in terms of IQs, we did add a new position to the recommended list. We did add 3 positions to our watch list. And as you might remember, that just means that we are monitoring that investment more closely and more frequently. In terms of SilverOak updates, the build out of our space has been completed. We'll be working on a number of technology projects in the second half of the year. And we are continuing to look, in this case, for a finance manager.
Yep. And actually, we're also actively interviewing for a trader. I know I have a interview with somebody
Today? Yes.
Well, Jonathan, again, I want to thank you and the rest of the team for putting all this information together, including those folks that make it possible from a technology perspective. And I want to thank everybody that attended. We really appreciate your involvement and encourage you to reach out to your SilverOak advisor with any questions. If anybody attending is not working with an advisor and you have questions, feel free to reach out to me directly. My number's here at 952-896-5701. Otherwise, thank you for your time. We really appreciate it and enjoy the rest of the day.